Hi, my name is Andrew Warburton and I'm the property advisor. In this video, I'm going to cover the really important question, should I refinance, yes or no? It's estimated that in 2021, trillions of dollars of loans will be refinanced, more than ever in a year in the history of the United States. And if you're one of those people, I want to ask you as a friend, that you will consider the things that I share with you. It's taken me 30 years to learn these things. Some of them I learned by making mistakes. Some of them I learned by going the right way. The most important thing is that you make an informed decision. This is the first out of 6 videos regarding refinance and how you handle your home loan to create wealth and stability for your family. I want to invite you to subscribe down below so that we can get you the information you need. Probably information that your loan officer won't give you. Certainly information your bank won't give you, because the system is set up in such a way that loan officers and banks make the money and it costs you money. So I want you to consider these things, and to make sure that we get all 6 videos to you, would you please click subscribe down below so that we can stay in touch and make sure you get all 6 of those videos and you'll be notified. Please put your questions down below, put your comments down below, and put a thumbs up for us. We'd really appreciate it. Let's go into the first video, refinance, yes or no. There are 3 primary reasons that people refinance their home. First of all, to get a lower payment. That's called a rate and term refi. You get a lower interest rate, and even though there's certain terms attached, you save a couple $100 a month, say, or $300 a month, or whatever. I want to let you know it's possible the amount you save you could pay 5 times over the length of the loan. And sometimes it can be very short-sighted. Sometimes it's the best thing to do. Secondly, people get refinances to pay off their bills. So this is called a cash-out refi. Now, when you do a cash-out refi, typically your interest rate is not as good as a non-cash-out refi. So when you look at those premium low rates, those rates are usually not for cash-out refis. It still could be lower, but it won't be the lowest rate. I would recommend to you that you would think, after watching this video, about consolidation loans through your credit union rather than a refinance. And I want to let you know, at the end of this video, I'm going to give you a hyperlink to a site where you can do further research on this for your loan. I don't want you to miss that. So hang in with me all the way through to the end of the video so that I can give you that hyperlink so you can do more study on your own. The third reason for refinancing is folks want to buy something else. It could be another property, it could be a boat, it could be an RV. They want to buy something else, and this is again a cash out refi. And again, even though you may save some money or you may pull some cash out, you could pay 4 times over for that money. When you watch this video, you'll see exactly why. Those are the 3 primary reasons for refinance. Now, I'm not telling you to refinance or not. That's your decision. All I'm saying is, would you look at the information? Would you consider the information, not only in this video, but in the 5 videos coming up, before you make a decision that could be great or could be not so good? So now I'm going to take this off the board, and I don't usually do this, but I want to go over some math with you very quickly, which is going to challenge, I think, the way some of us think. Loans have something called an amortization schedule. So it's not just a question of, oh, I saved $200 a month. Amortization, that's a long word, and it comes from French. And French is amour. Not amour, amor. That means to death. Okay? And it's amortization. That means that you want the loan, which is at this level right here, to go all the way to this level right here until it's dead, until it's at 0. That's why it's called amortization, till the loan is done. But amortization schedules are very clever. Understand that the idea of 30-year and 15-year mortgages haven't always been there. It used to be you had to pay it off in 5 years, and very stringent terms for the borrowers, which made it not possible for many people to buy. So bankers got together and they worked out a way that the loan could be secure for them to lend but at the same time easier for us to repay. And guess who cashes out? The banks do. And the bank loan officers do. That's why they're so nice to you when you come in the bank. Because if you follow their advice, they're going to make even more money. Now, we need their money to buy our homes and protect those we love. But if we understand the system, we can make more money than the bank does off us. And I think most of us would agree that's what we want to do. This has a lot to do with the amortization schedule. Now, I'm going to share with you right now some math that is extremely interesting. Sorry, I dropped my paper on the floor so you know I'm a real guy. All right, so again, at the end of this video, I'm going to share with you a link how to make these calculations yourself. Let's take a situation where you're borrowing $400,000. Now you can get that loan, oh my gosh, 3%, even less. But let's just take the example at 4%. Because this video is going to be on YouTube for years, eventually 4, 5, 6%. But with the link I'm giving you, you can recalculate. If this is a 30-year loan, your payment is going to be approximately, principal and interest, $1,909 a month. Now we call that P&I. That's principal and interest. Of course, you have to pay taxes as well, and insurance as well, and an HOA fee if you've got it. But right now, we're talking about principal and interest. Do you want to pay more interest, or do you want to pay more principal? Surely, if you pay more principal, you're going to reach to the more point sooner. That is where your loan is dead and over because you paid it off. So you want more going to principal. The banks are extremely clever, and I'm going to show you here a graph that describes this very simply. Here you go. And this is over time. This is 30 years. This is 0 years. I'm going to draw here a blue line and a red line. The red line is the amount of interest that you pay. So let's say here, this is 100% of your payment, which in this instance is $1,909. So in the first year, this is really stunning, in the first year, about 70% of your payment goes to interest, and only 30% of your payment goes to principal. And so you see over the course of the loan, the amount of your payment that goes to interest goes roughly like this. The amount of principal that goes to your loan goes roughly like this. There's the principal, there's the interest. Now, surely this is really good because you're taking your loan to death. You're paying off your loan. But at the beginning, in the first stages of your loan, that's not what's happening because the banks, surprise, surprise, have worked it out that you pay most of the interest up front and you pay the principal later. And guess what? 5 years into your loan, they come to you and say, we can save you $200 a month. And what happens? You go back to paying almost no principal and tons of interest. So they refinance you before this starts to happen, where you're paying off principal. That's not good because they're not collecting so much money. As soon as the bank sees this line dropping off, they want you to refi because they're getting less interest. They're making less money. So when it comes to 5 years or to 10 years, they're extremely motivated to refinance you. They want to tell you you're going to save $200, but they're going to lose thousands of dollars because they're collecting less interest here. What they want to do is take you back right here and start your amortization schedule all over again. So every time you refinance, you may only have 20 years left. It's not just that you have 20 years left, but the percentage of your payment that's going to interest drops off and the percentage of your payment going to principal increases. They don't want that. They want you to refi so they'll save $200 a month, save $250 a month. They've got another 10 years of collecting a huge amount of the payment to their interest. I'm going to give you one last example. Now, does this mean, oh my gosh, we should never refi? Not necessarily, but it does mean that you understand what's going on. We have lost in America the power of understanding paying off your home, the power of what happens in an amortization schedule. I'm going to run through this really quickly. I'm aware this video is a little longer than usual, but again, I want to encourage subscribe to these videos, because in these 6 videos, I'm going to share with you facts that will change the way you live the rest of your life financially. Look, on this $1,909 payment here, in say year 1, let me just go to year 1 really quickly. In year 1, out of your $1,909, $1,333 goes to interest, and $576 goes to principal. $1,333 to $576. That means 70% of your payment is going to interest and 30% is going to principal. Now, by the 5th year, so actually this will be the first month of year 6, look how this changes. Instead of $1,333, only $1,160 goes to interest, $749 goes to principal, and now 40% of your loan payment is going to principal and 60% is going to interest. Can you imagine here at year 5, the bank starts to panic and they're going to work the interest rates to get you to refi because you think I'm going to save $200, but suddenly you're paying off with your payment. 40% of your payment is going to principal, and that curve of interest is dropping. The banks don't like that. You could be close to being debt-free. You could be close to having an asset, which I will teach you later about wealth, which you can yield tremendous income on because your payment is dropping. Not your payment, but your principal balance is dropping and your net worth is growing. I'm going to give you 2 more examples. Look at year 11. So this is 10 years in, the first month of the 11th year. Now, $1,030 of the 1909 is going to interest. $879 is going to principal. You now have 54% going to interest, and you have 46% going to principal. One last example. Let's look at year 16. So this is 15 years into the loan, the beginning of the 16th year. Watch this. $792. Look, $792 goes to interest. $1,117 goes to principal. You have turned the table of wealth. Now, for the first time, 42% is going to interest and 58% is going to principal. What's the moral of the story? If you're in real financial dire straits and you have to refi, refi. If you were in just a horrible loan, you're going to save maybe 3 percentile points, probably a good time to refi. If you're going to save $200 a month and lose 10 years of paying off the loan, and you're going to drop back to 30% going to principal from 46%, or even worse, 58% going to principal, and you drop back to 30%, the bank resets, you need to think about that really carefully. Am I saying don't refi? No. Am I saying do refi? No. I'm saying make an informed decision. Do you want to know how to build wealth with your home and get a second home? Do you want to know how to do something guaranteed for your kids that will secure their future? Do you want to know how to lock in your retirement income? Then stay with me on this series. Please subscribe down below and we'll make sure that you're notified in this critical series of making wealth through real estate in America. Thank you for watching The Property Advisor.